I'm Caroline Hyde. This is Bloomberg Technology. Coming up, the Trump administration unveils, quote, the biggest tax cut in U.S. history. But what's in it for tech? We'll discuss. Plus, the FCC chairman officially out with big plans to kill net neutrality as we know it. Ajit joins us for an extended interview. And a Bloomberg scoop. Dropbox hits a key milestone on the way to its IPO. Our exclusive with CEO Drew Houston ahead. First to our lead, the Trump administration lays out sweeping proposals to reform the U.S. tax system. Here are the details. The plan proposes to cut the corporate tax rate more than half to 15% for businesses big and small. The top individual tax rate would also see a cut to 35%, and it would also offer a one-time tax of just 10% on the $2.6 trillion U.S. companies are currently stockpiling offshore. Now, U.S. Treasury Secretary Steve Mnuchin spoke with the White House briefing room and laid out why there needs to be tax reform.
Our objective is to make U.S. businesses the most competitive in the world. Right now, we have a 35% corporate rate on worldwide income and deferral. It is perhaps the most complicated and uncompetitive business rate in the world. Not a surprise that companies leave trillions of dollars offshore.
So how will the tech industry be impacted? We're joined by Simone, assistant professor at Stanford Graduate School of Business, focusing on corporate tax policy. With us in the studio, Tom Giles, executive editor of technology at Bloomberg. Lisa, I wanted to kick it off with you because you've been working with tech companies, you've been looking at the impact of potential tax reforms. Will this help tech giants?
Absolutely. I don't think there's a question. First of all, lowering the corporate tax rate, as the administration said, one of the biggest cuts in history ever, leaving more profits in the hands of companies. I'm sure they're going to be happier, and I'm sure the administration also hopes that with that extra money, they'll invest more, whether it's in innovation, research development, tangible fixed assets, or even human capital, increasing the number of jobs we have here in the U.S.
And certainly, Tom, bringing it to you, looking at the $2.6 trillion of cash held overseas, tech is a large holder of it.
Tech is one of the biggest holders. In fact, the biggest company, the companies with the most cash overseas, Alphabet, Google, Apple, Microsoft, Oracle, the list goes on. These are the companies that are poised, as Lisa pointed out, to benefit the most. My question for Lisa and what the people that we've talked to, including corporate CEOs, they've said rather than putting money into R&D, rather than bringing manufacturing from abroad to the U.S., what they plan to do with this is buybacks, dividends, M&A, and possibly paying executives more money. So my question is, what does that do for R&D? What does that do for innovation?
It's fascinating. I'm looking at the Bloomberg right now on my terminal. I've got the S&P 500 divided into sectors. Since the date that we saw the new president come in to be voted in, 9th of November, we have seen information technology companies perform the best, up 15.3% in terms of total returns. The anticipation, Lisa, is huge of what money can be brought back and how it can be better served for investors. What about consumers? What about R&D?
Well, I think the tech companies would argue that everybody benefits. Instead of having a large stockpile of cash overseas, that they're potentially investing in lower return acquisitions or just sitting there in cash, they can bring it back home, put it back in the hands of shareholders who could then go out and buy or invest in other companies. And that's the way that we'll see the innovation from this big break. I think the tech companies would be very happy to be able to redeploy their capital in the most efficient way. And the administration appears to be trusting that the tech companies will do that as a result of this change.
And we've talked about giants here, but what about the smaller technology companies? Is this going to help the small to medium-sized enterprises as well, do you think, Lisa?
Well, the small to medium-sized companies are probably less affected by the change in our international tax system, but they, of course, will still get the benefit of a big rate cut. And that flows through to not only the companies that have organized themselves as C corporations, but a wide variety of legal forms that are more commonly used by the small and mid-sized businesses. So they are getting the benefit of that big rate cut that they wouldn't have gotten under the previous tax regime.
Tom, I mean, it's fascinating because, of course, prior to potentially this holiday on repatriation money, we saw some rather, shall we say, creative ways that certain tech giants were using tax loopholes, particularly based in the Netherlands and Luxembourg, using tax havens, for example. Do we think that might come to a bit of an end?
Well, you still have an incentive to have a low tax rate overseas because you're still subject to whatever taxation scheme there is in that country, especially if the government, as has been indicated in today's outline, they move to more of a territorial system. You're still subject to the taxes in that region where you have the receipts. So you do have an incentive to keep it there. What would change, though, is you wouldn't have that same tax, that 35% here, that would kind of remove that obstacle. Now, to the point about the smaller to mid-sized companies, if you believe that cash brought from overseas is going to be used on M&A, that would benefit the smaller to mid-sized companies that could potentially become takeout targets. My question, again, getting back to this, what happens with the money when it comes back? The Trump administration has talked about wanting this to be a way of bringing manufacturing to the U.S., creating jobs. But if what you're doing is paying dividends and buybacks, does that really create jobs? Does that end up in the coffers of wealthy individuals and investors, or does it end up getting plowed back into the economy? And I think that's going to vary from person to person and from company to company. But there is a big question about that.
Yeah, Lisa, I mean, you've talked of how you think overall money will be better deployed, more efficiently deployed. But fascinatingly, of course, there's calls for more jobs, but automation is one of the key killers of jobs. Have you got a perspective on whether the tax changes as we see it will benefit the economy as a whole, as Tom was talking about there?
I do think it'll benefit the economy as a whole if the focus, though, is to try to bring back a certain type of job to the U.S., manufacturing jobs, for example. Well, that's a non-tax issue. That's potentially something that needs to be addressed through other types of policies, education, being a big deterrent to people moving from manufacturing jobs towards the types of jobs that are available here, like automation. Somebody has to program the software and provide maintenance for all of these robots who are going to be providing the manufacturing that used to be provided by humans. That's the shift that I think we need to make, because I don't think that we're going to be able to compete on the wages that are being offered by other parts of the world. And that's not a tax play. That's something different.
And to that theme that you just mentioned, we've been talking a lot about the repatriation and the money that we might see brought back because of this one-time tax holiday. But what about border taxes that has been so talked about? And what about exporters versus importers? Are there particular companies that might be worried about what might happen when they want to import pieces of equipment they need to use for their iPhone building, for example?
Absolutely. I think that's still the big open question mark that we didn't get a lot of answers on today. So we're talking about moving towards a territorial tax system where the United States companies are just going to be taxed on their business activities in the U.S. The question is how you define that. Up until this point, it's been based on where the profits are produced, where the economic activity is being done, the R&D, the marketing, all of those things. Now, the border adjustment tax is talking about changing that definition to where the product is sold. And that, no question, helps exporters who are not going to be taxed on their exports, and hurts importers who aren't going to be able to take the deduction for imported even components into stuff that they are manufacturing here. That's going to hurt them, and these are the companies that are potentially providing those jobs that we want so badly. So there's definitely winners and losers, and I think that's why we still don't have an answer on the border adjustment tax.
As always, some answers, still plenty more questions. Thank you very much for answering ours today. Lisa Simone, professor at Stanford University, and of course, Bloomberg Technology, Tom Giles. Great to have you with us. Now, a revolving door in tech. Chris Sacca, a prominent venture capitalist behind Lowercase Capital, says he's retiring from investing. Sacca was an early backer of Twitter, Instagram, Uber, and several dozen other companies, both as an individual investor and through his firm. He also clarified that Lowercase will not take on any new investments or raise more money from investors, but will continue to support its current portfolio companies. Now, coming up, one of those original Chris Sacca investments, Twitter. Well, shares soared Wednesday after the social network said user growth picked up in the first quarter. We'll dig into whether this growth will boost Twitter's bottom line next. This is Bloomberg. Now, Twitter finally seems to be addressing its biggest challenge, attracting new users. The social network reported that average monthly active users rose 6% in the first quarter compared to the same period last year. This growth comes as Twitter posted a year-over-year drop in quarterly revenue, though. Joining us now for a deep dive on whether Twitter's user growth will boost ad sales, our Forrester Research Director, Melissa Parrish in New York, and Bloomberg Editor-at-Large, Corey Johnson, who is right here in San Francisco. Melissa, I want to take it out to you first, because I'm looking at whether these numbers are going to be encouraging enough. 6% uptick in users. Is that the Trump effect? What's actually behind all of this?
The Trump effect, yeah, I guess we've all been talking about that a lot. I think to some degree, sure, it's a bit of a Trump effect, but I would say it's largely more about seeing the name Twitter in the press more than it is something sort of growth being directly attributed to the president. I think the name has been associated with current events more and more and more, especially in this last quarter. So sure, I think we can attribute some of it to the political and current live events that have been taking place and the conversation around that.
Corey, whether it's Trump or not, does this lure advertisers to start spending a little bit more with Twitter?
Well, we know the answer to that. The answer is no. I mean, these user growth, great, 4% sequentially over year. The user growth has been pathetic at Twitter and has been for quite a long time. If you look back all the way back to the IPO, you've seen 27% user growth over 3.5 years. That is not a big growth business. But you would think, well, at least they could start to pull some more money out of users. And yes, 2.8% growth, as I said, sequentially. That's better than it's been, a lot better than it's been. It still stinks, and it's still on a small base compared to Facebook, compared even to Instagram, where we saw fresh numbers from today. So those user numbers are pretty weak. But when you add to that their ability to monetize, again, if the users aren't growing much, at least they should be able to, with all the data they said they were going to get about users, with all the ways they're going to be able to find out how to pull numbers out of that. What's the question of sort of what is the revenue base and how fast is the revenue base growing? And the revenues were weak. The revenues were down on a year-over-year basis for the first time ever. But more importantly, the value of a Twitter user is going down a lot. How much they can charge for each user is getting worse and worse. They can't blame it on international. International is still about 79% of the users. The advertisers are just not willing to pay to reach Twitter users, and that's a real problem for this business.
Now, Melissa, to Corey's point, they said there was a great quote in the Bloomberg story saying, coming from Wedbush Securities, saying, when Facebook grows at 4 Twitters a year, that tells you that there's something really wrong here. Is there something really wrong, or are we just seeing a bit of a changing of how they're going to be charging, and will revenue eventually pick up?
I do think revenue will eventually pick up. But look, I mean, I'm a marketing analyst rather than an analyst for investors or financial analyst. And I think when I look at it, it's true. Revenues have been declining, and that's a scary story to hear. But from my perspective, they're doing things that will be more appealing, will make them more appealing to advertisers in the future. They're doing some hygiene. They're getting rid of some ad products that they know don't work. They are focusing on cleaning up some of their measurement. These are small things, admittedly, but they are things that look like they're going in the right direction. Are substantial changes really needed? Yes, I think so, both in terms of the core product and the ad products. I think we need to see some real innovation rather than some of the incremental changes. But from my perspective, the moves that they're putting in place should make them a bit more palatable to advertisers in the future, yes.
Yeah, but these minor changes, a bit more is I would agree. It's not quite lipstick on a pig, but a bit more incremental changes, 2% user growth. When you look at the value of a user, we showed you how the percentages have changed, but just the dollar amount. They got $1.67 per user this quarter, compared to a year ago, I think it was $1.93. The value of a Twitter user, that number should never be going down. They should always be learning more and more about their users. They should find better and better ways to use data. They should have closer relationships with their advertisers. And if you look, I think we've even got those numbers together. When you look at the value of a Twitter user on a dollar basis, again, going from $1.92 a year ago to $1.67 in the quarter they announced today, That's just the wrong direction, and maybe it's because they cleaned something up by getting rid of some advertising vehicles that they didn't want to have around anymore. But losing this NFL contract that they said was so important before, seeing these numbers go down in all the wrong places, it's a real concern. I know the stock was up today, but it's way down from where it was because what Twitter could someday be, it's becoming clear Twitter is what it is and might not change a lot except for around the margins.
I mean, you're right, Corey. The shares are still lagging near a record low for Twitter. Melissa, last question therefore to you, because you talk about the cleanup and you talk about how, some autoplay video, for example, will be less to charge for than other ways of videoing. But what, therefore, do marketers really want to see? What could Twitter do to really start to lure in the advertising bucks and make each of us who are on Twitter more valuable to those companies?
Well, I do think data is a big play here. They're making some interesting moves in their API platform, cleaning it up. I think they're going to be able to monetize to some degree that cleaned up, more hygienic and more accessible data stream. But that doesn't solve the ad revenue problem. I think we need to see some really robust new ad products. It's not going to be about autoplay video. It's a nice move to see, but I don't think that is the end game for Twitter if they're really trying to be profitable in the long term. I think it's something we haven't seen yet. I wish I had a good idea. I'd happily share it. But I think it's going to be some new, it will need to be some new ad product that we just haven't seen yet, or else they're just going to continue to lumber along the way they have.
Maybe they're going to be listening to you. Maybe we're getting a call. Forrester Research Director Melissa Parrish, great to have you on as ever. Bloomberg Editor-at-Large and the birthday boy in the house, Corey Johnson. Give him some Twitter love, because we know he might be maybe casting aspersions on the company today, but you're great on Twitter.
Much love for Twitter.
And your birthday. Now, a story we're watching today. PayPal shares popping in after-hours trading. Investors are starting to embrace the company's strategy of converting the online payments platform into a digital wallet. First quarter results show that CEO Dan Schulman's strategy is working as the company raises its annual forecast. Joining us tomorrow for an exclusive conversation is PayPal CFO John Rainey. Now coming up, Google's parent company Alphabet is set to report earnings Thursday. The numbers Wall Street will be focused on, explained. And a feature we'd like to bring to your attention is our interactive TV function. You can find it at TV Go on the Bloomberg. You'll not only be able to watch us live, but also see previous interviews and dive into any of the securities or Bloomberg functions featured. And you can become part of the conversation by sending us instant messages during our shows. This is Bloomberg subscribers only, though, I'm afraid. Check it out at TV Go. This is Bloomberg. Now, ESPN will cut about 100 staffers this week in an effort to save money. That's according to a person familiar with the matter who says the leader in sports TV is coping with rising costs and fewer subscribers. In a memo to staff, ESPN President John Skipper says the Disney-owned network is determining who to cut from the current payroll. Now, also out with earnings Thursday, Google's parent, Alphabet. It closed at a record high in the day's trading, but the company this past quarter has hit by a YouTube advertising controversy, with companies like AT&T and Johnson & Johnson at one point halting spending, citing concerns their ads would run alongside offensive videos. Now, Bloomberg's Scarlett Fu took a closer look at the company in the Numbers Don't Lie.
Google's parent Alphabet closing at a record high today, one day before it's set to release earnings. The company this past quarter was hit by a YouTube advertising controversy as companies including AT&T and Johnson & Johnson at one point halted spending, citing concern that their ads would run alongside offensive videos. Let's look at Alphabet in today's The Numbers Don't Lie. Now, any threat to advertising is a big deal for Alphabet. Its Google division dominates the digital ad industry along with Facebook. Together, the two of them own, or I should say, Google owns about 40% of the market, but together the two own about 60%. A lot of people call them a duopoly. Google advertising, I should say, makes up about 86% of Alphabet's revenue, a big chunk. And you can see advertising, the white line, above and beyond higher than the other business lines, licensing, the orange line, and the other bets division, which is the blue line. Google's properties like YouTube and Google Search have played a major role in the rise of digital advertising. When combined, internet ads on mobile, which is the orange bars. And on videos, the blue bars are set to surpass TV advertising right there going forward, not now, including now. So it just, the spread gets wider. Now, outside of this category, an increasing contribution from cloud services should continue to support Alphabet's revenue growth in the first quarter. The other revenue growth group has also seen a surge over the past few years. Don't be surprised, however, by surprise in earnings, because each year since 2012, we found that Alphabet has missed consensus sales estimates in the first quarter. Now, while analysts don't expect the recent YouTube advertising controversy to affect the results, they will be watching for comments on how executives are solving that issue. We'll be following Alphabet's earnings when they're released after Thursday's U.S. closing bell.
That was Bloomberg's Scarlett Fu earlier on. What did you miss? Now, coming up, FCC Chairman Ajit Pai calls for a repeal of net neutrality. Defenders vow a tsunami of resistance. We'll hear from Chairman Pai next. And if you like Bloomberg News, check us out on the radio. You can now listen on the Bloomberg Radio app, Bloomberg.com, and in the US on SiriusXM. This is Bloomberg.
I'm Elisa Parenti, and you're watching Bloomberg Technology. Let's start with a check of your first word news. The Trump administration has announced what it is calling the biggest tax cut in U.S. history. The plan cuts the top income tax rate from 39.6% to 35% and reduces the number of personal income tax brackets. The new tax rates would be 10, 25, and 35%. The French presidential candidate Emmanuel Macron was booed by factory workers in his hometown after an ambush by rival Marine Le Pen forced him into a confrontation with her supporters. Le Pen made a surprise visit to the Whirlpool plant on the edge of Amiens, while Macron was meeting with union leaders from the plant in the center of town. Russian Foreign Minister Sergei Lavrov is dismissing claims that international experts cannot visit the chemical weapons attack site in Syria because of security precautions. Lavrov says that claims by experts were warned that the UN was warned against traveling there, that they are not true. Germany is standing behind its foreign minister, who met with a group called Breaking Silence. That group is critical of Israeli actions on the West Bank. That's after Prime Minister Benjamin Netanyahu abruptly canceled planned talks Tuesday with the visiting minister. Germany defends its right to meet critical organizations in a democracy. Parts for a U.S. missile defense system designed to defend South Korea from the north have started to arrive. The THAAD system is being rushed into deployment on the site of an old golf course. Now, China opposes this installation, saying the advanced radar can penetrate its territory and undermine security. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti, and this is Bloomberg. It's just after 5:30 p.m. Wednesday here in New York, 7:30 Thursday morning in Sydney. I'm joined by Bloomberg's Paul Allen with a look at the markets. Paul, good morning.
Good morning, Elise. ASX futures are looking flat ahead of trading here, and Nikkei futures looking a little weaker in Japan. Markets there waiting on the Bank of Japan policy meeting. All but one of 39 economists surveyed expect to see no change in the policy settings from the bank. But looking ahead, most think the next policy move is going to be tightening. There's going to be a quarterly update on growth and inflation estimates as well, although Japan's a long way from that 2% target. The big one today comes out of Korea. Samsung earnings, final earnings report for the 3 months to March. Preliminary results show operating profit the best in almost 4 years. And out of China, watch out for PetroChina, Sinopec and CNOOC, among others. I'm Paul Allen in Sydney. More from Bloomberg Technology next.
This is Bloomberg Technology. I'm Caroline Hyde. Now, there is a major showdown brewing in Washington, cracking open the net neutrality debate. Federal Communications Commission Chairman Ajit Pai unveiled his game plan for rolling back net neutrality rules at a speech Wednesday in the nation's capital. Passed in 2015 by a Democratic majority FCC, the net neutrality rules aim to prohibit internet service providers like Comcast, AT&T and Charter from favoring or discriminating against online applications, content and services. Now, Democratic Senator Ed Markey from Massachusetts responded to Chairman Pai's repeal, saying, "It makes no sense. We cannot keep the promise of net neutrality, openness and freedom without the rules that ensure it. Chairman Pai and the Trump administration should expect a tsunami of resistance from a grassroots movement of Americans." Meanwhile, Pai and his backers say, well, the rules as they stand have slowed broadband investment and hampered the FCC's efforts to close the digital divide. Joining us now is the Federal Communications Commission Chairman Ajit Pai from Washington, D.C. Wonderful to have you with us, Mr. Pai. And first of all, I want to ask about how you intend to take on the tsunami of resistance. Have you braced yourself?
Well, this is going to be a political debate that will engage millions of people, but we are going to stay focused on the facts and the law. And the facts are that Americans, by and large, believe in a free and open internet, but they also want to have an infrastructure investment. They want those next generation networks to be built out. And so I think what the FCC doesn't need is heavy-handed regulations that saddle businesses with a lot of rules that simply disincentivize them from building those networks. And that's going to be the course we are charting henceforth.
Have you had commitments from the ISPs, the internet service providers, that if these rules are indeed repealed or changed, they will invest? Because I'm looking at the profits of AT&T, $14 billion, $8 billion of your Comcast shares have risen since that original ruling of net neutrality. They don't seem to have really been hurt.
If you look at the actual numbers with respect to investment, they are down 5.6% for the top 12 broadband providers in this country. And that doesn't even include the smaller providers who aren't included within that statistic. We have heard from a number of providers, cable, wireless, telephone, and others, who have told us that these Title II regulations, as they are called, are impeding them from executing on their business plans. They're not spending as much, they can't get as much financing, and as 22 ISPs, small ones, told us just yesterday, Title II hangs over our businesses like a black cloud. And that's the kind of regulatory uncertainty and overreach that we want to remove, because every American deserves better, faster, and cheaper internet, and I'm committed to delivering it to them.
So you take away some regulation and oversight. How can you therefore ensure that the right rural areas are indeed provided for?
Well, two things. Number one, Title II, the net neutrality regulations, take us in the opposite direction. They reduce competition and they increase what is called digital redlining. So companies have more of an incentive to look at rural areas or low-income urban areas and say, you know what, we're not going to get enough of a return on the investment there. Let's not deploy. But secondly, we want to make sure that everybody has the internet access that they need and want. And so I've got a very proactive, pro-consumer agenda to promote internet access, especially for those on the wrong side of the digital divide.
And so you say you're taking some replacement regulation advice, you're looking for suggestions. What do you think will come to the fore when you ask for this sort of advice?
Well, that's precisely the reason why we have started this conversation. As I said in my speech today, this is the beginning of the discussion, not the end. And so we want to hear from the American public, what is the best way to preserve those core values of a free and open internet, of more competition, of greater investment in infrastructure? I'm confident that we're going to be able to find a way that will appeal to consumers in the time to come.
You're talking a lot about consumers, of course, very worth fighting for, and you're going to hear their voices. You've already heard the voices of perhaps smaller startups that might be affected by this. We've got 800 startups, investors led by Y Combinator, concerned about the rollback of net neutrality. You've also heard from the bigger players, the 40 top internet companies, also voicing their discontent. The letter to yourself you received today from the 800 tech startups saying, rather than dismantling regulations that would allow the startup ecosystem to thrive, we urge you to focus on instead policies that would promote a stronger internet for everyone. How can you allay their sorts of fears?
Well, I think a free and open internet is what has delivered unparalleled value for the American consumer. And 20 years ago, who could have foreseen that companies like Google and Facebook and Netflix would have become household names, not just here in the United States, but around the world? They thrived because of the light touch regulatory approach that started in the Clinton administration and proceeded through the Bush administration and the first 6 years of the Obama administration. That is precisely the kind of framework that I believe will promote startup entrepreneurship everywhere in this country going forward. And so I'm committed to giving giving them a chance to succeed. But Title II does not allow them or others the ability to do that.
Then why are they so worried?
Well, I think a lot of people have stirred up a lot of hypothetical harms and hysteria based upon what they think will happen. And if you looked at the FCC's 2015 decision, you would look in vain to find any example of systemic market failure where internet service providers were acting to block access to lawful content, for example. And so going forward, we want to take a very fact-based approach and figure out the best way to preserve, as I said, those core values, a free and open internet, to allow startups and entrepreneurs to thrive, and to preserve an incentive to invest in infrastructure and increase competition. Those are the kinds of things that will allow everyone in the internet economy to benefit.
So thus far, I mean, the argument is more competition will basically promote the likes of AT&T and Comcast to play by the rules and make it a fair and open internet for the content providers. Is there any way that you think this could be measured or should be measured? Are you going to look for any sort of oversight? I know that you don't want it to be heavy-handed, as you say.
Well, that's one of the reasons why we are going to be asking for public input on what the regulatory framework should be. We know that Title II is not the right answer, but as we'll see, and I'm going to be publicizing the entire text of my proposal tomorrow, we tee up a number of different ideas for how to do it. And we ask the public, is there anything else that we should be thinking about going forward? So I think there is a way to do it, and we're going to try to find the best way in the time to come.
And therefore, when you go out there and start discussing, also trying to bring perhaps some Republicans to, and as well as Democrats into your line of thinking, what do you think will be the best way of getting certain Democrats who are so against this on board or convinced? What's your key line of clarity, do you think? Because at the moment, as you say, you want to stick with the facts.
Well, look, I mean, we obviously are going to be doing more of a fact-based approach than we did previously, but the bottom line is this. The arguments I'm making today are precisely the arguments that were made by President Clinton in the 1990s, the arguments that were made by President Clinton's FCC chairman in the 1990s, the arguments that were made by Democratic senators in the 1990s. This is not some radically political fringe argument that I'm trying to make. It's the light touch approach that served the United States well under Democratic and Republican administrations alike. And so I want to take the political heat out of this argument to the maximum extent possible. I understand that's going to be difficult to do, but at the end of the day, Americans are best served, I think, with a light touch framework that focuses on the facts, adheres to the law, longstanding legal principles, and respects the basic principles of economics. That the more heavily you regulate something, the less likely you're going to get more of it.
Would you prefer Congress to step in here rather than, you say you want to take the political heat out of it all? Would it be better to have Congress and a legislative compromise so that we don't have this back and forth every time there's a change in administration?
Without question, 3 years ago, I suggested when the FCC first started down this road that the ultimate solution the best solution would be for Congress to sit down and tell us what the rules of the road should be. And that would take the FCC out of this business of trying to shoehorn the realities of the modern marketplace into an 83-year-old legal framework that was designed for Ma Bell, the telephone monopolist of the 1930s. If Congress speaks, if our elected officials tell us what they want the FCC's role to be in the internet economy, I will respect that. I think the American people will respect that. That is the best solution going forward.
FCC Chairman Ajit Pai, always great to get your time. Thank you so much for giving so much of it today on Bloomberg Technology. We wish you well. Now coming up, our exclusive interview with Dropbox CEO Drew Houston, the company's latest milestone as it charts a path towards IPO. This is Bloomberg. Now to our exclusive conversation with Dropbox CEO Drew Houston. The cloud file sharing startup has been touting financial milestones as the company inches towards a public offering. Dropbox is already cash flow positive with annualized revenue of more than $1 billion. And Houston just told us that they are also EBITDA positive. Now, I spoke to him earlier this morning at Dropbox's headquarters in San Francisco. Take a listen.
It's been great. We have 500 million people around the world using Dropbox. We've got 200,000 paying business customers and a lot of milestones that we're proud of. So in January, we crossed $1 billion revenue run rate, and it turns out we were the fastest SaaS company in history to reach that milestone. And last year, we shared we were free cash flow positive. And today, something we haven't shared is that we're also profitable on an EBITDA basis. And that matters because it's a rare combination. So it's rare for software companies to be operating at our scale with our level of profitability, and to be growing at the rate that we are. So we're really proud of that.
Profitability, the enigma. How did you achieve it? Is it about cost efficiencies? Is it about the growth side? How have you managed to scale to that?
Well, it starts with our customers. So people love Dropbox. And I think it's a testament to the strength of our business model. So inside the company, we like to say we have 500 million salespeople, because all of those millions of people have brought Dropbox into millions of businesses. And that's how we grow. And so it's the vast majority of our revenue is self-service. And so you just pay with a credit card, which means our sales and marketing costs are a lot lower. And so when you combine the scale and efficiency, those are the ingredients.
And it's interesting that you've helped, through Dropbox, lower the cost of business for an awful lot of other industries and areas. Where do you see these sorts of efficiencies going in terms of technology in general? I'm interested in your viewpoint on whether you're an optimist or a pessimist as to whether technology is pushing forward and helping efficiencies work, but at times there will be disruption. How do you feel that Silicon Valley is adopting that, indeed administration adopting that?
Well, I think when you zoom out, technology is progress. And there are a lot of great things about that, and that's kind of the story of humanity and our evolution. But when you zoom back in, one thing that we talk about is that for every problem that technology solves, it feels like it creates a new one. And so things like email and thumb drives were, at the time, these great inventions. But when you look at it another way, they were kind of holding us back.
Yeah.
And so, fortunately, a lot of these pain points become opportunities for us. Whether the frustration around thumb drive is just one example of a broader problem that we're working on, which is what we call work about work. And so when you add up all the time we spend looking for information and emailing and all these things, it's something like 60% of our time is spent on just overhead and work about work. So what we've done is we're trying to put a dent and knock that number down as much as possible, because it's a huge waste. And then when you think about tech more broadly, I think we'll end up in a good place, but I think at the same time as technology, whether consciously or subconsciously, creates new problems, we have to be mindful of that, and we have to be solving those issues too.
When you say we have to be, do you think that's for the entrepreneurs and the business leaders to be looking at? How much do you think the administrations, whether they be in the US or globally, also need to be looking at it?
I think whether we're a company and the company and the government, we're all part of a broader community. So I think it's something that everybody has to look at. When
you're looking at the current administration in the US as well, there's been, rolling of eyes and exhaustion coming from Silicon Valley at many times, feeling, particularly whether it's the travel ban, they're moving on to H-1B visas. How have they hit your business, if at all?
Well, it's been an unpredictable 100 days or so. And look, sure, a lot of the positions that the administration has taken, or a lot of things like the executive orders on immigration, are really troubling. Arash, my co-founder, his parents immigrated from Iran. So if that kind of legislation or if that kind of thing was in effect now, there would be no Dropbox, or when we started. And so we're all rallying together and figuring out what we can do to engage.
Rallying together in Silicon Valley, is Silicon Valley at the best place it could be right now, do you think? Is some of the reputational damage that is happening at the moment, is that something you want to look to fix, or do you think it's thriving and as fresh as it's always been?
I think it's always complicated. We focus on the things that are in our control, and so we see when we talk to our customers, there's a lot of problems out there that no one's solving, and so that's where the bulk of our attention goes.
And I want to get a little bit of insight as to where you'd tell other entrepreneurs to go now. Reach out to our viewership, those that are wanting to be Drew Houston, wanting to see the next IPO and wanting to see their business scale, such as yours. Have you got like one or two recipes for success, do you think?
I think when it comes to a lot of these problems, one thing that was surprising to me is it's actually easier to go after big problems than small ones. Because I thought it would just be harder. Because the challenge is so much bigger. But actually, what happens is people are really motivated they're inspired to take these things on. It's easier to attract great talent. And so that's my advice would be to set your sights high.
That was CEO and co-founder of Dropbox, Drew Houston. Now coming up, China's ride-hailing app Didi has neared the close of a massive funding round, vaulting the company to another level in the startup world. Details just ahead. This is Bloomberg. Now, ride-hailing startup Get is taking on large competitors like Uber and Lyft and getting a big leg up in a major US city. The company announced it's buying New York-based ride-hailing firm Juno for $200 million. Get is based out of Tel Aviv and is popular throughout Europe. Juno offers its drivers company stock and better pay, helping it gain a lot of ground in the New York market. And sticking with ride-hailing firms, Didi Chuxing is close to a milestone. The ride-hailing giant is near an agreement to raise $5 to $6 billion in a deal that would make it the most valuable startup in China, surpassing smartphone maker Xiaomi. Now, the round will lift Didi's valuation to about $50 billion. That's up from $34 billion after its acquisition of Uber's China business, according to people familiar with the matter. Let's head live to Hong Kong, where Bloomberg's Lulu Chen has the story for us. Lulu, give us the details, the nitty-gritty on this funding round. We know the valuation could be significant. They've got some big VCs that already back this company.
Exactly. So Didi's raising about $5 to $6 billion. They're close to closing the fund. The main investors will include SoftBank, Silver Lake, Bocom, CMB, and like you said, at $50 billion valuation, they are China's largest startup, surpassing Xiaomi. Even on a global scale, they would rank only second to Uber.
Quite phenomenal. Two ride-hailing companies, the most valuable startups in the world. What is Didi going to be doing with this money? Is it going to be taking on its former rival, now frenemy Uber, a little bit more?
Right. So there's a lot of areas that they can explore. I have to say that this money is coming in a very timely fashion. The past few months have been very tough on the company, especially since the Chinese government issued these stringent regulations that hampered a main revenue stream of theirs. So this buys them more time to develop more revenue avenues and delay a possible IPO, which was floated as an idea last year, according to people familiar with the matter. In terms of other areas that they can explore, driverless technology, they're definitely locking heads with Uber and also Google in those areas. Didi still has global aspirations. They still have an ally with Grab and Ola in Southeast Asia and also India, so still competing with Uber on those fronts.
Talk to us about India and some of the other regions they've been looking to get in. Has it been successful? Has it been a hard slog for them?
Right. Well, Didi has basically taken on an approach to partner with the local competitors, local operators like Ola in India. They are not actively building out an organic business on the ground there. Same case with Southeast Asia and also regions like South America, which they said they've also have interest in expanding in.
So fascinating. We could see an IPO coming from China, perhaps faster than we'd see Uber going public. Talk to us a little bit more about the regulatory hurdles they've had at home, though. You mentioned them, that some revenue streams have been hurt in China. Which ones are we talking about here?
For Didi, the majority of their revenue still comes from their private car hailing service and their fast car service. Basically, think about it as UberX. And the Chinese government has issued these regulations across dozens of cities across China, especially in Beijing and Shanghai. They've limited the number of people who can drive on the road to only local residents, higher requirements for cars as well. So this has really cut down on their revenue stream in those sectors, which has probably been their main revenue, their area for profit, and what investors were looking forward to when it comes to talking about a potential story for an IPO of the company.
The road for ride-hailing companies never runs smooth, it seems. Thanks so much, Bloomberg's Lulu Chen, live from Hong Kong. A great piece from her on the funding round. Now, that does it for this edition of Bloomberg Technology. Earnings season continues thick and fast on Thursday. Amazon, Microsoft, Google, Intel, all reporting results. We'll have full coverage and analysis as ever. This is Bloomberg.